Well, happy Monday and welcome back to Managerial Accounting, the sequel here. So I'm going to do two little mini lectures for you. I'm going to do one mini lecture, and that'll be this first one here on the take-home part of the exam. Then I'll do another mini lecture on the multiple choice part of the exam. If you go to Brightspace and you look in the grades section, you will see that you can look up your grade on the third exam, and you can look up your overall grade for the course. How I got the overall grade for the course is I basically took the three exams, which were worth 75%, and took your homework grades, which were worth 25%, averaged them, using the formula given in it was 75% exams and 25% homework, averaged them up, got a number, compared that to the grading scale in the syllabus, and that's how I arrived at the grade. All right. So let's just, again, we'll start here by calling up the problem part or the opportunity part. And this should be relatively fresh in your mind. So you started out here having to compute variances, and we had to compute, always start with the solutions here, what they ask for. The fixed factory overhead volume variance. So anytime we produce less goods than we had planned to produce at full capacity, we're going to have an unfavorable volume variance. And then the variable factory overhead controllable variance. So for the controllable variance, what you need to do is to take the actual amount spent on variable overhead and compare that to what it should have been based on the volume that we had. So first, let's start. First thing that we got to do there is compute the factory overhead volume variance. So we assume that we would have 50,000 units was our capacity. Our 25,000 units is normal capacity. So it takes 2 hours to produce a unit. So in terms of hours, there should have been, if we are full capacity, we would have worked 50,000 hours. If you take the actual number of hours worked, it was produced 24,000 units, and each unit required 2 hours. So that gives us 48,000 hours. So we were under capacity by 2,000. So that is going to give us an unfavorable volume variance. Anytime you produce less than capacity, you've got an unfavorable variance. And the standard fixed factory overhead rate per hour is $9 per hour. So the fixed factory overhead volume variance, which is unfavorable, is 18,000. Some of you get confused between whether it's favorable or unfavorable. So, if you had it going in the wrong direction, I only took off a point. And then for the next one, the factory overhead controllable variance, take the actual amount spent on factory overhead and compare that to what it should have been using the budget based on the number of units actually produced. So we produced 24,000 units. Each unit requires 2 hours, and the variable overhead rate is $3.50 per hour. So we had $170,000 worth of variable overhead. We should have had 168, so we had an unfavorable controllable variable overhead variance of 2,000. So both of your variances are unfavorable. So part C, you had to add them together. So the total variance for overhead is 20,000, and it is unfavorable. Okay, so that's the first one. Each of these were worth 10 points. Next one's kind of interesting. I didn't realize this until I mapped it out. Essentially, in part A, you've already answered part A. You've already answered, got all the information you need to answer in part B. So part A is the transfer. So we've got this company. They're produced materials used by used in producing Division A's product is currently purchased from the outside. However, they got another division that we could purchase it from. So this one has to do with transfer pricing, and we do have unused capacity, and we can produce the units for the other division at $20 per unit. That's the variable cost because the fixed cost is not relevant, but the variable cost is. So we've got basically what is the impact overall on operating income on the company as a whole? What is the impact on Division A, and what is the impact on Division B? And if the negotiated approach is used, what would be the range of acceptable transfer prices? Well, acceptable transfer price is the lowest possible transfer cost that you'd want to have would be the variable cost of producing the unit, which is $20. And the maximum price that you wouldn't charge is $30 because that's the amount that's being charged by the outside vendor. So, what is the impact on Best Spread's operating income? So what happens, you take a look at the two divisions there. So Division A's operating income, they're currently paying a market price of $30. The transfer price was to be $25 times 60,000 units. So they're saving $300,000. That's for Division A. And Division B, the transfer price is $25, but then the variable manufacturing cost is $20. So they're making $5 in each unit. Multiply that by 60,000. So they increase their profits by 30,000. So you've got cost savings in one division of 300 and additional profits in another division of 300. So the total effect on operating income is 600,000. Right? So in this one here, Division A, you've already got this information here. Income Division A is the same for what it is here, down below. And what's the effect on Division B? Well, you can see that Division B, it's the same calculation you had done earlier. All right? And then here's the range, which we had already talked. So at a minimum, you got to charge the, at least cover the variable cost. And at a maximum, you don't want to end up paying internally more than you pay the external supplier. Okay, that's number 34. Let's take a look at number 35. Number 35, we've got three divisions, and we want to use the DuPont formula here. So remember what the DuPont formula does is the DuPont formula says return on investment is the profit margin multiplied by the investment turnover. So profit margin is operating income divided by sales, and investment turnover is sales divided by invested assets. So you multiply those together, and what you find for Division E, they've got a profit margin of 11%, inventory turnover of 2.08 roughly. So they got an ROI of 22.9. Division F, they have a profit margin of 860 divided by 4,800,000 or 17.92. And they've got a investment turnover ratio of 1.92. So their ROI is 34.4. And Division G, operating income divided by sales, 860 divided by 7 million, and then investment turnover, sales divided by invested assets. So they've got a profit margin of 12.29 and a turnover of 2.4138. So the one that has one is the most profitable, the one with the highest ROI is F. It's got 34.4, which is definitely the most profitable. Okay. Number 36. So here was a decision of whether or not to discontinue a product line. Right? So they give us all the information we need. We got an income statement. We know that product J is working at a profit of 2,750. And they give us all the different cost structure there. And then with regard to product J, if we've gone ahead and discontinued it. So here's what's currently happening with product J. And here's what happens if we discontinue product J. So the question, should the company discontinue producing product J, prepare a differential analysis. All right, so here's what, if we currently continue to produce the product, we're gonna have a profit of 2,750. If we stop producing the profit, we're going to have a loss. Basically, what's going to happen is there's going to be no revenues. The variable costs will go away, but the fixed costs would still remain. So the effect overall, the differential analysis, is you get a drop of revenue of 275,000. You would eliminate the variable cost of goods sold and other variable expenses of 51,450. But overall, you would be down $93,000. So they should continue to, it's better to have a profit of 2,750 than to lose 90,250 by discontinuing the product. So you get a $93,000 swing there that suggests that you should continue to make it. 37 was the special order here. So a couple of you made the same mistake here. You assumed that the unit cost was $6.50. So therefore, if they took an order of $6, that they would be losing 50 cents on each unit. So therefore, they shouldn't take the special order. Okay? But you missed this line here. Company has enough excess capacity to make this order. So they've got unused capacity, which means that the fixed costs are not really variable, not really for a special order, the fixed costs really aren't relevant. So what would happen in terms of if should they accept the special order or not? Well, they've got 4,000 units that they could sell for $6 a unit. That's 24,000. And the only additional cost that they would have would be the variable costs. And the variable costs here are direct materials, labor, and variable overhead. That totals $4. So you don't have to consider the fixed factory overhead because it's going to be there anyway because they've got additional capacity, unused capacity. So they would actually make an additional $8,000 by taking the special order. So yes, they should take the special order. Okay. And the last one, this is why in class, and I noticed a couple of you who missed class got this one wrong, and that's the disadvantage of coming to class, because in the class where I briefed everybody on the exam, I said, please highlight this last line here. Determine the average rate of return. Okay? So the average rate of return, they also said there may be some stuff in here that you don't need. So the average rate of return would simply be the operating income, average operating income over the 4-year period. So operating income is 320,000, 4-year period divided by 4. So you've got 80,000. And when you look at the cost of the project, so all these present values are nice to have, but they're not really relevant because you're computing the average rate of return. So the average rate of return, so you get the operating income each year, the average operating income divided by the average investment. So the capital expenditure was 810. You can assume there was has no salvage value, so you add the salvage value to it, that's 0. So 810 divided by 2 gives you 405. So there's your average income, there's your average investment, so it's 19.8. Those of you who messed it up did something other than the average rate of return, or another mistake that was made is that you didn't, that 810 was only the investment for the carrying value of the investment the first year that's going to be depreciated over time. So the average cost is going to start out at 810, it's going to end up at 0. So the average there is going to be 405. Okay, so I hope you found that review useful. And what I'll do is I'll do a separate one on the multiple choice. And again, if you want to see what you did actually, your score on the final and your overall course grade, just go to Brightspace and look in grades. Okay, I will see you shortly for the multiple choice part. Adios, au revoir, hasta luego.